Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday, the 8th of March, 2022. And yesterday we published part one of our interview conducted with Mr. Saul, the CEO of the Pure Gold Company. Now, yesterday we discussed a range of issues, particularly around gold and its historic performance, and why it is an asset class that has survived and held steadfast through the test of time. We also touched on other asset classes and their significance, and in today's interview we look more specifically at silver, the gold to silver ratio, and why silver should, in Josh's view, be $100 an ounce, even at current gold price levels. We also look at a new product accumulator plan that the Pure Gold Company has recently introduced. Now, if you want to see part one, we've put a link both in the description box and in the comment section below. But let's now go to the second part of this fascinating and informative interview.
And I think I'm a big believer that I don't think that any one asset should compete with one another. You know, this interview or conversation shouldn't really be about gold versus equities or gold versus cryptocurrency or gold versus oil, because I think that there is genuinely a need for every single one of those asset classes within a portfolio. I have equities myself. I have cash myself. I've got gold. I think, the crucial element in terms of determining how much of it you hold within your portfolio is timing. I think timing takes a decision to do something or not to do something, and it will turn it into a good investment or a bad investment. You know, clients of ours don't necessarily look at physical gold and silver as an investment, because effectively when people invest, they're assessing how much risk that they want to take on. And when people purchase physical gold and physical silver, essentially what they're trying to decide is how much risk do they want to remove from a physical context, if that makes sense.
Oh, it does indeed. And again, I agree with you. I have to admit, though, you're taking the fun out of this for me, because I love comparing one asset class with another. And a lot of our subscribers will be very much aware of the fact that I occasionally tease them with cryptocurrencies, which most of them actually loathe. But at the same time, having said that, one cannot, for the short term, argue cryptos have generally performed and outperformed all other asset classes, even though they've taken a sudden sort of slump in recent weeks. Having said that, though, what does fascinate our members is this interrelationship between gold and silver. And we saw, I think, was it last year or the year before, the gold to silver ratio rise above 125, I think, if memory serves me correctly, at one point. It's now resting or move between sort of 75 to 80 to 1. Where do you see that readdressing in the years ahead? Is silver going to gain a march on gold, or is it too difficult to tell?
Well, it's a difficult thing to accurately predict any market at the moment. What I can tell you is that, most of the experts and commentators within this space would say that, the two metals should be trading within a ratio of around 12 to 1, 12 to 15 to 1. That was the relationship between the two metals for many, many years. And then, of course, we saw gold shoot up in 2006, 2007, and it left silver behind. And if I'm being completely upfront with you, silver has been completely underwhelming in terms of performance. We've all been kind of waiting with bated breath for silver to amplify as we expected it would. Most people, they value the fact that silver should be trading at least by about $100 an ounce relative to where the gold price is at the moment. Silver is used far more within industry than gold. because it's used within, conductors, it's used within technology, catalytic converters, photography, medicine. I think the big contributor, and I think the big difference over the next 10 years as opposed to the previous 10 years, is the fact that most countries around the world are so conscious of their carbon footprint, in that I would say most cars over the next 10 years will probably be electric. And so many of those components within those cars have to be silver. There's no other conductor other than silver within those lithium batteries. So I would say that, and I know we've heard this all before, but I would say that the one big difference between now and then is the space that we are moving into, in terms of most cars on the street being electric, and therefore having demand for silver from an industrial point of view, for getting investment for 1 second. And I think, a lot of our clients have been very excited about silver. We've seen a lot of the central banks and a lot of the institutions, JP Morgan, HSBC, they've purchased a lot of physical silver, and very, 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 very quietly. There's obviously lots of manipulation within these markets, but they're clearly purchasing silver because they see a very good reason to do so. And, we've heard all sorts of rhetoric that, in 10 years' time, there won't be enough physical silver to satisfy, industrial demand, like the requirement for cars and batteries and what have you. And I guess I see it in a very similar way to what we saw the price of gold back in the 1970s. 1 minute it was $20 an ounce. And then all of a sudden it jumped to 75, all of a sudden it jumped to 300, all of a sudden it jumped to 800. And you look back and, the gold price increased thousands and thousands of %. And I would say that there is little risk in applying the same sort of blueprint to silver as a metal as it becomes more affordable. It provides the same sort of hedge against inflation that gold does, but it's used within industry far more than gold. And therefore, I believe, and I believe a lot of experts and commentators believe, that silver has the ability to do well during times of unrest, given that it tracks the price of gold, but it also has the ability to do well in times of prosperity, when demand for manufacturing and cars is very, very high. So look, if you were ever going to buy an asset class, you would want to ensure that, relatively speaking, you were buying at the bottom of the market. And I think, when you talked about the silver price, back in 2011 to the silver price now, you're completely spot on. I think, but in US dollar terms, the silver price is 50% cheaper now than it was back in 2011. But the fundamentals that support the silver price increasing, I would say, are 10 times stronger today than they were back then, which surely makes, it paves the way in terms of taking advantage of a massively undervalued asset class with, I believe, longevity. And we've been having lots of conversations with clients at the moment, and our conversations aren't always about, you should be buying gold or you should be buying silver. It's far more of a holistic conversation about, right, well, what are your alternatives? We're living in an environment whereby we have undeniable geopolitical risk. And, that existed back when Korea were arguing with the US, or the US were arguing with Korea, whichever way you decide to look at it. We're now seeing it with Russia and Ukraine. We don't know how bad that is going to get, and how much that amplifies within the market. We've got inflation at a 40-year record high, and depending on which metric you decide to use, CPI or RPI, what I can tell you is that both of those measures don't include things like construction costs that are now 30% higher than what they were 2 years ago. And I believe it's a relevant point, because everyone needs to repair things in their house. And, if you need to use disposable income to do that, then all of a sudden that's 30% more expensive. They're going to have to put up rates in most countries to control inflation. And they're talking about, especially in the UK, putting it up to pre-crisis levels of around 5%. So if they do that, effectively people's mortgages are around 500% more expensive than they are at the moment. You stick that in the basket of goods and services, again, that inflates inflation far more than the 5% guidance the government are giving. Then you take into account property prices, rent, or to buy a property, that's gone up far more than what they've guided inflation to be. Petrol prices, energy, people are expecting energy prices to double in various countries. So, a lot of experts suggest that actually inflation should probably sit conservatively at around 9 or 10%. So in order for anyone putting their money in the bank, for them to earn a real rate of return, interest rates would have to be 9 or 10%. For that to happen, I believe debt would become almost 1,000% more expensive. For me, I couldn't stomach my mortgage being 1,000% more expensive. Not quite sure what we would have to do, but most people would have to sell their houses because, effectively it would be cheaper to rent than it would be to pay your mortgage, to pay your debt off. So this comes back to looking at what are the alternatives? Do I keep money in the bank that's earning less than 0.5% with inflation either at 5%, which is what is reported, or at 9 or 10%? By doing that, effectively, you are losing money every single year, and not slowly anymore. So if you've decided, well, you don't want to keep it in the bank, not just because of inflation, but also counterparty risk is high. Banks, some of them anyway, are not in the greatest of positions. A lot of them don't have the right sort of capital adequacy ratios. Well, then what's your next option? And in no order of preference, people may well look at property or equities or cryptocurrency. So, if we're looking at property, well, look, property is a great asset class. It's something that provides income. It's something that, we all need in terms of a roof over our head. But in terms of timing, the property market is the highest it has been in over, well, forever, actually. Is it high because there's a finite supply of property, or is it high because we have had record amounts of debt being taken out by people that probably wouldn't be able to afford it if interest rates were to increase? And I think regardless of that answer, they're stopping to, as they start to put up interest rates, less and less people are going to take debt. And with less debt will mean less property purchases. With less property purchases, that slowdown will start to increase. And if you factor in the fact that people may well start to default on some of their debt, or unemployment might increase because of what we're seeing, then more people might have to sell. And the combination of those two variables will mean that property prices could come down. Most of our clients, and we have lots of property developers, see more downside risk in the property price decreasing than increasing. Again, I see it as a real opportunity at some point in the market. I don't see the opportunity right now. And it's not as liquid as, let's say, equities or cash or physical gold. So when we then move on to, let's say, the equity market, this for me is particularly interesting because, again, we have lots of clients that when they're purchasing gold, they're considering these other contemporaries, like equities and like property. And with, equities, the S&P 500, the Dow Jones, we've enjoyed the longest bull run in over 200 years. We accept the fact that the equity markets tend to correct themselves once in every 7 to 10 years. So we are around 3 to 4 years overdue a correction purely based on timing. But if we look at, let's say, price to earnings ratio, the price to earnings ratio at the moment is around 33 times, which is the highest in history, bar no event. And what we've seen is that if you look at the price to earnings chart throughout US history over the last 140 years, if you were to draw a line across that chart, what you will see is this. Every time throughout history over the last 140 years, whenever the price to earnings ratio has hit 27 or higher, we are followed by a monumental crash. We saw it in 2008. We saw it in the year 2000. We saw it in the year 1987. And I think the year 2000 is an interesting one because effectively, what we saw, what we saw back in the year 2000 is the birth of a lot of the tech stocks, the dot-com bubble burst. And this is when we saw, Facebook weren't even in existence. These companies had really large captive audiences, but they hadn't effectively monetized them yet. So the point is, analysts were giving them these crazy valuations above and beyond their earnings because they understood future potential, but the money wasn't there. And the point being, they couldn't really value them. And, now with the likes of Amazon and eBay and all these other fintech companies, exactly the same thing is happening as we speak. And, as I was saying, if you look at the price to earnings ratio chart over the last 100 years, if you were to take that pen and draw a line straight across US history, you will see that without one historical exception, whenever the price to earnings ratio hits that 27, we've been followed by over a 50% crash in the stock market. And there are literally no exceptions in history. So I guess going back to what we were talking about in terms of equities performing to 9%, I would say that is amazing. We've been able to do that. Why have we been able to do that? Well, I think fiscal policy has a large part to play in that. We've had record low interest rates. We've had money printing, which has contributed to a huge inflation of the stock market. We've also had an enormous amount of corporate buybacks whereby, corporations have used free money from the money markets to buy back their own stock, which therefore inflates their stock, makes the stock market seem bigger than it actually is. But I would say that all of this amounts to the fact that we're on borrowed time. And it might be tomorrow, it might be a week, a month, it might be a year. But if you look at what the smart money are doing, and if you have a look at, let's say, the smart money flow index, you can see institutions selling and removing exposure from these sorts of markets in earnest. And you can see that, the smart money, they don't tend to do this dance of, 2 steps forward, 1.5 steps back over 20 years. And the reason for it is that, they advance 2 steps forwards and they may well have liquidated prematurely, but for them, it's about being able to take advantage of a variety of different markets and cycles at the same time, instead of, moving 2 steps forward, 1.5 steps back. And that's what we're seeing at the moment. And, just to kind of, to finish this kind of comparative analysis off, a lot of people don't even spend much time talking about bonds or gilts because effectively you're locking yourself into a vehicle whereby you are guaranteed to lose money over a 10-year period. And there's not much you can do about it. Now, cryptocurrency, I think the notion of cryptocurrency is quite amazing. It really is. What has been created and invented over the last 10 to 12 years has been quite fascinating. And I do believe crypto is here to stay. What I would say, however, is that it's not established. It doesn't have a track record in terms of safety and security in times of uncertainty. It is highly, highly volatile. And that may well be to your benefit. You know, we've heard of amazing stories where people have made thousands of percent within a really short period of time. Unfortunately, you know, people have also lost a lot of money by trying to ride those gains, purely because no one's able to see the volatility coming. You know, sometimes, you know, they operate within a realm of their own. So when we get to looking at, you know, what asset class to put your wealth into, it's a question of, well, if I've taken away all of the other alternatives, but I need to do something, gold and silver in its physical form tend to present an asset class that tends to increase in times of uncertainty, something that keeps pace with inflation. Let's not forget that the definition of inflation is that is the rise in cost of commodities and services, and by definition, gold and silver is a commodity. So, you know, again, by definition, gold and silver keeps pace. And even if, let's say, you know, we've seen a lot of this over the last couple of years, clients aren't necessarily convinced that they want to be in the gold and silver market long term. They may well want to purchase property, but they want to wait for it to become, you know, present better value at a lower price. They may well wish to buy into the equity market if and well it corrects itself. But what do they do whilst they're waiting for that particular point in time? And a lot of these people put their wealth into physical gold and silver through nothing more than a holding pattern. And I think, you know, during this kind of modern era of uncertainty, physical gold and silver have been used as a long-term store of wealth, but also a temporary holding pattern for investors or everyday people or clients to decide what it is they really wish to do with their wealth.
Josh, you've been very generous with your time, but I would like to ask you two more questions, if I may. The first one is a softball one, really. So I'm here now thinking, shall I invest in gold and silver now, bearing in mind both of them have risen quite substantially in the past few weeks, partly because of the Russian-Ukraine situation, partly because of the rather high levels of inflation, or CPI, as they call it in the United States. Should I perhaps not wait until, because we're going to have rising interest rates, the Fed's likely to raise rates in the middle of March. The Bank of England's talking about a third interest rate rise in March now, because we've had one in January and February. And of course, when interest rates go up, that tends to have a dampening effect on commodity prices. So should I wait until those interest rates take place and wait until the war or the incursion with Ukraine is over? Because if that happens, surely gold and silver prices will fall. How would you answer that?
It's a really good question. And, you know, no one has a crystal ball, and it's impossible to predict, you know, first of all, what governments are going to do, what markets are going to do, what markets are going to react to what governments might do. Obviously, we can use what has happened before as a bit of a guide, but we're sitting in uncharted territory. So the first thing is that the government's decision to push up interest rates in the face of being able to control inflation, that was all decided and planned before they were aware that Russia would invade Ukraine, and before any sort of consequence as a result of any other country getting involved might ensue. So, you know, that wasn't factored in. And I believe, and I wouldn't be surprised if come, you know, the later part in March or April, various governments decide to hold off increasing interest rates so as to remove some of that volatility within the market on account of what we're seeing with regards to Russia and Ukraine. The other factor is this. In 2015, we saw a similar issue in the US. They decided to put up interest rates for the first time in quite a long time. And I remember back at that particular point in time, the much debated topic was, well, if we put up interest rates, that is going to strengthen the dollar. It is going to weaken the value of gold and also silver. So therefore, we should wait until that happens. And if you go back to 2015, what you'll see is that when they increase interest rates, their debt became more expensive. The ratings on various bonds decreased, and the US basically had to make a U-turn on their interest rate because the market couldn't handle it. So when they made that U-turn, you'll see that that was the beginning of gold and silver's ascent up until today. I think by waiting, which is clearly an option, what you are not appreciating is what you are removing risk from, because waiting until they increase rates does not reduce risk from a counterparty point of view. I believe that if they were to increase rates, it is going to put far more strain on homeowners, debt owners, and governments that have to repay debt, and whether or not they do it or not. And at that point, you might see the gold price increase as a result of, you know, people struggling with their own finances and markets becoming even more unpredictable. I would also say that the markets are relative. We never know what's going to happen. And back in 2007, when we had what was coined the credit crunch, and back then as well, we had, you know, the various wars on terror and Afghanistani interventions and what have you, the same conversation was debated at that particular point in time. You know, the gold price has increased 50%. Should I wait for it to come down, or should I purchase? Some people waited. Some people waited for 3 years because the gold price continued increasing to a point where it increased by 330% over a 3 or 4 year period. What we tend to say to our clients is that in the absence of not knowing one way or another, it makes sense to hedge. No one knows. We're all surprised by the unsurprisable. And actually, the only thing that's become more or less predictable is unpredictable markets. So with that being true, hedging yourself, you know, if a client, if you've got £10,000 to put into physical gold and silver, you know you want to do it for the various reasons that we've already outlined, but you're just not quite sure about price at this point in time. The safest thing to do without gambling away would be to purchase some now and then some at a later date. Rely on some of our guidance for timing, because we don't have our only vested interest in terms of timing is for you to do as well as possible. You know, we're not selling stock, we're not a shop. So whether or not you buy when the market is high or whether or not you buy when the market is low makes no difference to our margins. So it only works for us if you buy low and you sell high, because it means that our reputation is enhanced as a result of it. Excuse me. The other thing I think is worth taking into account, and this is where we really hold our own in terms of our consultative approach, is that it's not all about the gold and the silver price. You know, you're purchasing a physical asset class, which means that premium has to be taken into account. And premiums fluctuate. You know, premiums will fluctuate based on a variety of factors: supply, demand, inventory requirements, logistical supply chain. And just because, let's say, the silver or the gold price has come down, if more and more people are trying to acquire that physical metal, then premiums might increase, which therefore might mean that you end up paying more despite the gold or silver price coming down. So what we try and do is we try and create an environment whereby you've got harmony between the silver and the gold spot price, but also the buying and selling premiums, because effectively that is what is going to enhance your buying price for the metal in which you acquire.
Josh, that is great. final question for you then. Basically, I mentioned earlier that we have subscribers and followers from all over the world. Are you able to cater for all of their needs, almost regardless of which country they come from? And if that's the case, we will be providing a link to your website. Can you just go through the process of what actually happens if someone makes an inquiry? And for those who perhaps fear the fact that, oh, if I phone, I may be obligated, can you put their mind at ease, please?
Yeah, perfect. So the first thing to answer your question is we can help everyone. The first need is talking to us with no obligation nor any commitment. You know, you'd be surprised. We've had conversations with people whereby we said, you've got the right idea and the right inclination, timing's not right. You know, come back to us in 3 or 4 days, come back to us in 2 or 3 weeks. Sometimes the client circumstances don't necessarily warrant purchasing physical gold and silver, especially if it's, you know, ultra short term, you know, for example, over, you know, a week or 2 weeks. So what I would say is, you know, get in touch with us. We have qualified consultants that come from a variety of different backgrounds. You can have a conversation with them. They will give you procedural guidance in terms of how it works, how the market works, timing. The conversation can be as detailed or as brief as you like. And, you know, this isn't for us to sell metal to anyone. You know, our turnover is increasing phenomenally, but we have an inbound approach whereby we don't cold call any of our clients. You know, for us, it's a question of assisting people who wish to make a purchase. So as far as we're concerned, we want to give you as much information as possible so that you feel informed making some sort of a decision. So, you know, if you've decided that this is the route you wish to go down, then we'll ask you to complete an online purchase order. We don't accept card or check, and that's a benefit for our clients because we're not regarded as a money dealer. And because we're not regarded as a money dealer, we don't have to account to HMRC for every single one of our clients purchasing metal from us, which I understand the other providers have that obligation. So funding your account will be by way of a bank transfer. Clients will then decide exactly how, you know, what they wish to purchase, in what denomination, whether or not they want delivery directly to their door, or whether or not they want to take advantage of secure and assured storage. All clients get a transaction invoice, a certificate of authenticity, which verifies the weight, the purity, the gold or the silver content, and that includes our details on our buyback guarantee. Clients are able to obtain valuations at any particular point in time. But I would say that, you know, if there is an inclination to find out more, I believe that in this particular market, you know, knowledge is absolute paramount. It's key. So get in touch with us and, you know, the rest will make sense after that.
That's tremendous. Josh, thank you so much. Any last words or anything perhaps we've not covered you'd like to sort of leave with our followers at all?
I think we've covered most of it. I would say that the other thing that I would say is that sometimes, you know, gold has become more expensive. Silver is becoming more expensive, as we've seen a 15% increase. And we've got a really exciting product called the Accumulator, whereby clients are able to, you know, if let's say for supposition, they're not purchasing as a lump sum, they can create a plan whereby we withdraw money every month, and they are sent either gold or silver coins every month, or it's stored in their vault. And the beauty of this product is they can cancel it at any time. They can pause it at any time. There's no commitment. But, you know, we've had clients that have been doing this for, let's say, 4 or 5 years. And as a rule of thumb, you know, if you're saving £500 per month over a year, that equates to $6,000 or pounds, right? And over 5 years, effectively, you've got around £30,000 or dollars. Now, if the experts and banks and commentators are correct, and over, and if over the next kind of 5 to 7 years, we see the gold price and the silver price do what it did between 2007 and 2012, whereby it increased by 330%, then, all of a sudden, you've got a portfolio that's gone from 30 up to, let's say, 75, taking into account the various different price points in which you purchase. So signing up for an accumulator, if you think that, let's say, you haven't got enough money to purchase a lump sum, is a really good way to get started within, this sort of a market, especially as the gold and silver price continue to increase.
Josh, thank you so much. Really appreciate your time. As I've said, we'll put a link below to the site, and anyone interested without commitment can just make a basic inquiry. Thank you
for
once
having
again.
me.
My pleasure. Well, that's our interview with Josh concluded, and we sincerely hope and trust you found it worthwhile. We certainly did. It was very generous of him to give us an hour of his time, and as you can see, we did not edit any part of the interview. For those interested in a consultation or discussion without any obligation with the Pure Gold Company, please contact them via our link below, which is in both the description and the comment section. And if you do telephone, do mention our name, Illuminati Silver, so they may source the inquiry. Now, tomorrow we shall publish the interview in full, and if you have any friends or family who may be interested in what Josh has had to say, then please share that video link. Meanwhile, let us know what you thought of today's interview, and whether you would like to see us conduct more interviews of a similar nature. Meanwhile, thank you so much for listening. If you haven't done so, please subscribe to our channel, not forgetting to press the bell sign so you're notified of our videos as and when they are published. Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.